All right, let's talk about Zions Bancorporation's fourth quarter earnings. Now, on the surface, this was a fantastic report, but the market's first reaction was to sell. So what was going on? What did those initial investors miss? Let's break it all down. First things first, Zions delivered a huge earnings beat. We're talking earnings per share coming in a full 19 cents above what Wall Street was expecting. That's a clean, decisive win for the quarter. No two ways about it. And that brings us to the big puzzle of this quarter, right? How does a bank crush it on both earnings and revenue, only to see its stock immediately dip in after-hours trading? Well, that's exactly what we're going to unpack here. So let's start by just laying out the headline numbers and that initial kind of confusing market reaction. Okay, so you can see right here, it was a really strong showing all around. The official GAAP earnings per share came in at $1.76, which is a solid 12% beat over what analysts were predicting. And revenue? That also topped expectations by nearly $14 million. I mean, by any typical yardstick, this is a very, very strong quarter. And yet, what was the market's first move? To sell. The stock fell almost a full percentage point right after the release. You know, that kind of knee-jerk reaction suggests the market was either completely ignoring the good news or was focused on something else entirely. To really understand what happened and what the market eventually figured out, we have to look past the headlines. We've got to dig into the fundamentals that drove the quarter. This is where the real story is. Now, this is super interesting. Management pointed out a couple of one-time items on the call. They had an 11-cent gain from an FDIC refund and a few other things, but they also had an 8-cent hit from a charitable donation. So if you adjust for those to get to the core earnings power, you still land at around $1.73. That's still way above the $1.57 consensus. So yeah, the beat was absolutely legitimate.
And check this out. This is a huge piece of the puzzle. Zions expanded its net interest margin, that's basically the profit a bank makes on its loans, for the 8th consecutive quarter. It hit 3.31%. In this kind of tricky environment for banks, to consistently grow that spread, well, that's just a sign of excellent management.
On top of that, their credit quality was just pristine. We're talking annualized net charge-offs of just 5 basis points. That is an incredibly low number, and it shows that Zions isn't taking on a bunch of undue risk to get these great earnings. And underpinning this whole thing is a rock-solid capital base. Their Common Equity Tier 1 ratio, which is a key measure of a bank's financial strength, stood at a really robust 11.5%. This gives them a massive cushion. And, as we're about to see, a lot of flexibility. Okay, so the quarter was strong, we've established that. But for investors, what really matters is what's coming next. So let's shift to the guidance, because this is what really builds the case for the stock. The message from management was clear and confident. Here you have the CFO, Ryan Richards, basically setting a very positive tone for 2026, signaling growth across the board. And they gave us some specifics. They expect moderate increases in both their core interest income and their fee income. And yeah, while expenses will also rise a bit to fund that growth, they're targeting positive operating leverage. All that really means is they expect revenues to grow faster than costs, which is the very definition of profitable growth. That's the name of the game. But this, right here, this was the real tell. The CEO, Harris Simmons, directly signaled that more capital is coming back to shareholders. This is the piece that the market initially missed, but eventually latched onto in a big way. So the crucial takeaway here is this. Zions is getting ready to ramp up its share buybacks, and it's probably going to happen in the second half of the year. With a strong capital ratio and growing earnings, they have the firepower to really increase returns to shareholders. This forward-looking message is what totally turned the tide. Once investors had time to digest the full call, that initial caution just gave way to a surge of confidence. And the price action tells the entire story. You see that initial dip after hours, but then the next trading day, the stock rallied sharply, gaining over 4%. The market had a night to sleep on it, read the transcript, and realized the fundamental story was just much, much stronger than that first reaction. So what does this all mean going forward? Well, now it's time for our take on Zions. We've synthesized everything from the earnings call into an actionable thesis for you. Our call on Zions is broken down into 3 parts: our expectations for the next quarter's results, our forecast for the stock's price action, and, of course, our final rating and price target. So here it is. We are rating Zions an outperform with a price target of $65. The combination of strong core earnings, expanding margins, pristine credit, and that clear catalyst of accelerating capital returns, it just creates a really compelling case. The market has started to recognize this, but we believe there's more room to run. And now, for our outrageous but plausible trade idea. For those looking to isolate Zions' superior execution, you could consider a pair trade. Go long Zions shares while simultaneously shorting the SPDR S&P Regional Banking ETF. This trade is basically a bet that Zions will continue to outperform its peers, insulating you from broader sector moves and focusing the trade directly on this company's fundamental strength. This is not financial advice.